Hi everyone, this is Alan Rosenfield, Managing Director of Harmony Asset Management, and this is our latest edition of Thoughts and Comments, second quarter review and looking ahead. We're going to actually look at three different areas in today's discussion. First, a quick review of the markets in the first half of the year. And secondly, we're going to look at three sectors that are influential components for investing. And this will lead us to our final segment, which is investment strategies based on what we see for the rest of this year. Stay tuned. So let's jump right in. As everybody knows, markets were down in the first half of the year. But what a lot of people didn't realize is, in fact, only one sector was up for the year so far, and that's energy, which was up 31.8%. This was really all due to the fact that commodities started rising in price rather rapidly in the first half of this year, and it was across the board in all sectors of the economy. And the outcome of that was that regardless of the sector of the economy, you were getting hit with some massive inflation. So whether that was housing or it was energy or any goods or any services, we were seeing very rapid price rises. This led to the Fed starting to aggressively raise rates, something we've argued they should have done a long time ago, but at least they've started. They started in April and May, and that, of course, is what led to the market's tumble. For the first half of the year, the S&P ended up down 20.6%. The NASDAQ composite ended up down 29.5%, and even treasuries, long treasuries, were down 22.5%. The next sector we're going to look at is going to be three influential components that impact investing, and we need to analyze this carefully in order to understand where we want to position ourselves going forward. So stay tuned. There are three influential components, for a lack of a better word. They're cycles in a way, or at least that's the best word I've come up for, that we watch because they influence markets and investors, and you ignore them at your peril. The first one that we're going to talk about is what we call an economic cycle. And so what we're reviewing here is macroeconomic information. And we're going to be popping up a whole bunch of charts for you to follow along with as I talk. So we're going to start with commodities and take a look at how they've been performing. First one that you're seeing here is oil, WTI. So if you notice that oil has risen rather dramatically, as we all know. But if you take a look at this long-term chart, this is a 10-year chart, you can see from 2015 to 2020, oil prices were actually pretty flat. I mean, they've gyrated back and forth, up and down, but at the end of the day, you were pretty much where you started. That changed when we started getting into 2020 and 21. From 2021 to now, prices have been rising rather rapidly. So there was some change going on since 2021 that has made prices rise rather dramatically. Now, in the last 4 months, we've started to see a real pullback. Now, you're still dramatically higher than where we were a year ago, but you've dropped about 20% from the highs. So that's something that we'll watch, because if oil prices were to continue to drop and stabilize, that would have a positive impact, because oil is a major feedstock for most things in the economy, either directly or indirectly. This next chart that we're going to pop up now is natural gas. And you're going to see natural gas very similar to oil, one, in its importance, and two, when you start looking at the 10-year chart and then the 1-year chart, you'll see a very similar price movement. Big moves up in the last couple of years, followed by some pullback here. And the question is, where does it stabilize? When we move ahead and now look at agricultural and food types of commodities, you're going to see a mix. Some of them have stayed very strong, even though there's been some volatility, and then others which have surprisingly gotten quite weak. So let's take a look at these charts. So the first one we're looking at here is beef, and you'll see it's at near all-time highs. Same thing when we bring up a chart on poultry, near all-time highs. If we bring up corn, very similar. Now, corn has some special qualities that make me not surprised by that. Corn requires a lot of fertilizer. Fertilizer takes a lot of natural gas, so you can see why prices are up around. But when we look at this final one for wheat, even with all the talk of the Ukraine war and how nothing's getting through, look at how dramatically prices have dropped in the last couple of months. Next, we're going to look at copper and lumber, both of which are very important to the housing industry, but they are also important to a number of other industries. And what you'll notice in both of these cases is that once again, we've seen big jumps, but now we've seen dramatic declines in pricing. And in the case of, for instance, with lumber, you're near 2-year lows. So there's very mixed results when we're looking at commodities. Let's turn to other economic data. Consumer spending has started to slow. It's still positive, but we are seeing early signs of some slowing in consumer spending. Industrial production, capacity utilization, these have started to get weaker as well. In addition, many retailers have been reporting that they've got excessive inventories, which is a big change from where we were 3 to 6 months ago when they were having difficulty getting anything on the shelves. So now they're going to have to start reducing prices to clear out that inventory. Finally, you look at the labor markets. The labor markets are still quite strong. Companies are still finding it very difficult to hire skilled employees, and the labor shortage has led to large growth in wages, which in the one hand is very positive because wage growth has been absolutely flat for 20 plus years. But on the other side, it's a major sticky part of inflation. And so it's a big thing that we need to watch. We've had a couple of companies that have started to slow down hiring or even start to announce some layoffs. Others have threatened it, but we haven't seen a lot. So this is an area that we're going to have to watch and see if, in fact, we go from labor shortages to where we're laying people off, in which case your labor markets are going to get a little bit more in line. And then the last area we want to talk about is housing prices. Housing prices are at highs. According to the St. Louis Fed, median home price in the United States today is now $429,000. To give you an idea, back in 2005, prices were half of where they are today. And if we just go back 5 years, we're up 37% in the last 5 years. At the same time, mortgage rates have been rising. They're now at about a 5.7%. They peaked at about 6.3 and they pulled back some because housing is starting to show some signs of slowing, but prices really haven't started coming down dramatically yet. Now, this is something really to watch because you've got a combination here of interest rates that are higher, even though they are not at historically high rates at all, but prices of homes are at historically high prices. So the combination is squeezing people out of the marketplace. The second cycle that we want to review is the corporate earnings cycle. Now, we're just getting started in second quarter earnings this week, so it's too early, so we can't give you data so much as tell you what we're going to be looking for. So first and foremost, we're going to be watching what earnings and revenue results are, in fact. More importantly is we're going to be looking at what margins are like. Remember, the dollar has been getting strong as the Fed has been raising rates, And for US companies that do a lot of business abroad, which is a large percentage of the S&P 500 and the NASDAQ, all of a sudden, if your products are expensive because the dollar's high, that could have some impact. So we're going to watch that. We're also going to watch guidance. What are they saying about the third and the fourth quarters? Do they talk about the strong currency? Do they start talking about any plans for reducing employment or for actually laying people off? All of these will have an impact on what the Fed does and will have an impact on valuations for stocks and bonds and every other investable asset. So that's why this one's so critical. And that leads us to the third cycle that we want to review, which is the liquidity cycle. And this is directly tied to the Fed. So the Fed started well before 2008. It really started back with Alan Greenspan in the late 90s, started artificially keeping rates low. And this over time led to all sorts of markets getting out of whack. Remember, 2008 was about over lending in the housing market, and that blew up. And then everything came down again, and they kept rates even lower. They took them very close to zero. And so what you did was you artificially made the dollar cheap, and so people could borrow to invest, and that's why you saw the markets move up, whether you're talking stocks or bonds or real estate or art. All of it appreciated wildly. We were actually seeing inflation, but we weren't seeing inflation in the economy, and we've mentioned this before in other videos. We were getting inflation in assets. Now we're getting inflation in the economy, in sticky parts of the economy. The Fed must break the back of inflation. If they don't, they lose control. If they lose control, they lose credibility, and the economy falls off of a cliff. So it's critically important that they continue to be very diligent about interest rates. Well, without knowing where corporate earnings are yet, they will be looking at wages, they will be looking at unemployment, all of those areas. And right now they're so strong, they have to keep raising rates, even if it leads to a recession. And Chairman Powell has said that point blank. He will raise rates even if it means a recession, because he cannot afford for interest rates to rise out of control. So right now, overnight rates are at 1.75%. Their target is between 3.25% and 3.5%. We only have 4 more Fed meetings this year. The first one, or the fifth one, is next week, July 26th, 27th. Then there's one in September, one in November, and one in December. So in order to get to 3.25% to 3.5%, they are going to need to raise at least 3 times, at least. And so that means they are not going to get dovish anytime soon. The question is whether the markets recognize this. And if you start seeing a slowdown in the economy, and then if you get corporate earnings starting to slow down, and yet at the same time the liquidity is draining because the Fed is raising rates, okay, you're going to see, in that scenario, stocks down. You're going to see a weak economy. You could very well see a recession at that point. But they don't have a choice. They need to do this. So these 3 cycles are critically important to analyzing what we think is going to happen. And that's what we're going to talk about next. So here in our final segment, we're going to take all the pieces of the puzzle we've been looking at and try and put them together, and out of that come up with an investment strategy or strategies that we blend together for clients. And the first thing I want to say right off the bat, we're talking general strategies here because specific strategies really depend on suitability for each individual investor. And So we're not going to sit here and tell you buy this and sell that or how much to do, because without knowing your situation, it would not be appropriate for us to say you should do this. It may be the exact wrong thing for you. But these are general areas that we as a company are utilizing for our clients. So having made that disclaimer, let's take a look at the pieces, summarize the puzzles of what we know and what we're thinking about. What do we know? We know the economy is still strong enough that the Fed is going to have to continue to raise rates, even if that means that we could go into a recession. 2, we know that the federal government has continued to keep pressure on energy. That's going to keep energy prices up, and as we noted earlier, energy is a feedstock for most areas of the economy, and so you're going to see some sticky inflation that's going to be hard to break the back. What don't we know that we're going to be watching? Things that are all kind of tied together. One, we got to watch earnings, and we want to look and see what kind of guidance we're getting and whether they're talking about starting to lay off people. Because what happens then? Well, this is where things get a little bit murky, and that's the whole point. You look at this and I said, okay, well, maybe this, or it's maybe that, or it's maybe something else. All I'm left with is confusion. What are we going to do about it? Well, that is the uncertainty. I'm stealing a quote from a friend of mine. Matt, I told you I was going to plagiarize you, so here it goes. Better uncertainty than fear. Uncertainty we can plan for because we simply diversify and play various strategies. When we get fearful, we start panicking. So better uncertainty over fear. So what does this mean? It means since we don't know exactly where, we're going to first start by getting defensive. That means remove lower quality investments, remove higher risk types of investments, because they're much more dangerous at this point in time. To a large degree, as we are getting rallies, we're using that to exit things, not to add new money to risk. We think it, by and large, is way too early. So that's the first thing. So next, you're going to diversify so that when something zigs, something else zags. It doesn't mean that you make a lot of money on all these things, although maybe you do, but the real critical element here is that we are trying to protect capital and make sure that we're balanced enough so that we don't have too much exposure in any one area. So what does this mean? It means we want to own high quality stocks. It means we want to own high quality fixed income. We want a lot of it to be short maturities because you're getting good yields there, and you're not getting a lot more yield if you go out maturity length. But at the same time, at some point, you're going to want to own longer maturities, because if, and it's again an if we end up in a recession and so stocks go down more, people will start selling stocks and going to fixed income for the safety. And then people will start to say, the Fed will start to lower rates. In anticipation of that, then you will start to see the long end of the curve come down. You can make a lot of money on the long end of the curve on 10 and 20 and 30-year treasuries if rates move enough. So having some in both of those areas gives you potential. Now, there is the risk because GDP, debt to GDP in this country is very high. It's 129%, just too high. At some point, that can cause additional problems and higher interest rates and higher inflation. But I think that's a longer term scenario right now. And we're talking about something over the next 6, maybe 9 months, not something that we're holding for the next 10 years. So remember, we're being tactical here, which isn't day trading, but it means we're not buying and holding for the next 5 to 10 years either. So, and then the third area that you want to add in is cash. You want a lot of cash, short-term treasuries, 3-month, 2-month, 1-month treasuries, money market. You want liquidity where you're getting some yield, but you don't have any significant risk to your capital, so that you've defended yourself until things become more clear. So that leads us to where our strategies are. Again, remember, this is not a one size fits all. It really depends on your own situations, your own risk reward parameters, your own comfort levels. So talk to your advisors before you just try and implement what I've talked about generally, but this will be a good starting point to understand how we're thinking rather than running for the hills and panicking. Our bottom line is that we continue to maintain a defensive posture, well diversified between cash and equities and fixed income. We're using stock market rallies to reduce risk and to add shorts where it's, again, if it's suitable for people, as a hedge. So we're not doing big leverage things typically. But in this way, we've got things blended, long and short maturities, long and short stocks, a lot of cash, gives us a lot of flexibility as we see what the economic data, what the liquidity data, and what the earnings data continues to be as we go through the third quarter and into the fourth quarter. So I hope you found this helpful and informative. If you liked the video, please click the like button below and you can follow us here. If you have questions, feel free to reach out to us. We'd love to discuss these things. Thank you again for listening.